Ever feel like these big corporations are playing, a really high stakes game of chess? With their companies, I mean.
Oh, yeah.
Well, they kind of are.
Yeah.
In the world of mergers and acquisitions, at
Yeah,
least.
they are. It's a really good analogy.
Yeah. And today, we are diving deep, no pun intended, into your stack of M&A resources
Right.
to arm you with the knowledge so you can be in the boardroom with these people calling the shots or at least understanding what's going on.
Yeah, that's right. See the Matrix.
Right.
It's about decoding the game, really.
Exactly.
What's fascinating to me about this whole world is that it's not just about the numbers.
Okay.
It's about strategy and risk. And these two companies, sometimes even rivals,
Right.
they're deciding to join forces, or one's taking over the other.
Yeah.
It's a fascinating dance.
Let's unpack that a little bit. We've all heard the terms merger, acquisition,
Right.
but for people who maybe haven't spent their days in a boardroom, what are we really talking about here? What's the difference? And does it matter?
It absolutely matters. You hit a really key point there, which is that the difference between those two terms can be subtle, but it's really important.
Yeah.
I mean, a merger, right, usually implies like two companies, roughly the same size, coming together
Okay.
to form this totally new entity. It's more like a partnership, right? Like a
Okay.
true merger.
Okay.
You picture like two rivers, both strong, merging into an even mightier river.
I like that.
That's that kind of idea.
Yeah. So it's more almost like a meeting of equals,
Exactly.
pooling resources, expertise
Right.
for some sort of shared vision.
A shared vision.
Okay.
Yeah, exactly.
What about acquisitions then? They seem a little more one-sided.
They can be, yeah.
Yeah.
In an acquisition, you have a dominant company. We call that the acquirer.
The acquirer.
And they're essentially absorbing this other company,
Right.
which we call the target. Now, this could be a total takeover, right?
Yeah.
Like a hostile move.
Yeah.
Or it could be more strategic. Maybe they just want to neutralize a competitor. Maybe they're after a specific technology. But it's definitely more of a strategic chess move.
Right. And I imagine in this game of chess, both the buyer and the seller have very different goals.
100%. I mean, the buyer, right, which again, could be a company or maybe an investment group, they're driven by their strategic objectives. It's all about strategy with them.
Right.
Maybe they want to expand into a new market. Maybe they're trying to get a hold of some cutting-edge tech, or, maybe they just want to eliminate the competition.
Yeah.
It happens.
Oh, yeah. Yeah. It's cutthroat out there.
It is. It is. But ultimately, they're looking for that missing piece of the puzzle, right?
Yeah.
That thing that's going to give them a strategic advantage and help them dominate the market.
Okay, so they're looking for that thing to put them over the top. What about the seller? I mean, they're not just rolling over.
No, not at all. I mean, the seller, right, the company being acquired, they have their own reasons for doing this, their own motivations. Maybe they desperately need cash, right? Maybe the market they're in is dying and they need to get out. Or maybe it's as simple as their shareholders see this great opportunity to cash out and make a lot of money.
Right.
So, yeah, they've got their own things going on.
So it's fascinating how those different goals create this high-stakes negotiation.
Oh, absolutely.
Where really both sides are just trying to get the best possible outcome for themselves.
For sure. It's a dance.
Yeah.
Very intricate dance.
But I imagine before any deal even gets considered, there's a ton of research involved, like a ton of due diligence.
Oh, tons. Due diligence is absolutely crucial in this game. It's like, before you buy a house, you get an inspection, right? Make sure everything is okay.
Yeah.
This is like that, but on a much bigger scale.
Yeah.
You're hiring a team of, corporate detectives
Okay.
to investigate every single aspect of that other company. And we're not just talking about looking at their financials, although that's a big part of it, but it goes way deeper than that.
So it's more than just making sure the numbers add up.
Way more. You're really getting into the nitty-gritty. I mean, we're talking about diving deep into how they operate, looking at their legal standing, checking out their management team, even trying to get a feel for their company culture.
It sounds intense.
It can be.
So what are some of the key areas that these corporate detectives, so to speak, what are they looking at specifically?
So let's start with the most obvious one, right? Financial due diligence. I mean, this is like the foundation.
Okay.
You got to make sure the numbers make sense. So you've got financial analysts, right? They're scrutinizing the target company's financial statements, their tax records, anything and everything related to their financial health.
Okay.
Looking for any red flags, any inconsistencies, basically anything that might be a sign of trouble.
So making sure the books are balanced, there's no funny business going on.
Exactly. You don't want any accounting tricks, any hidden surprises.
Right.
They're also looking at trends, right? revenue, profitability, cash flow, all that good stuff, to figure out if this company is stable and if it's actually got growth potential.
Makes sense.
But it doesn't stop there. We're just getting started. Next up, you've got tax due diligence.
Oh, right. Can't forget about the tax man.
No, you can't. He always gets his cut. So in this part of the process, tax experts are digging into the company's tax history, their compliance, any potential liabilities, basically making sure there are no unpaid taxes, no unresolved audits, no risky tax strategies that could come back to bite you.
Ouch. Yeah, that could be a nasty surprise.
Yeah, taxes are no joke. So they're really making sure everything is above board, no skeletons in the closet.
Okay, so we've covered the financials, the taxes. What else?
Right. Well, then we get to the really interesting part. Commercial due diligence.
Commercial due diligence.
Yeah, this is where you're really trying to understand the business from a strategic standpoint.
Yep.
They're looking at the target company's position in the market, their competitive landscape, the overall outlook for their industry.
So it's like, are they a leader in their space or are they barely staying afloat?
Exactly. Are they going to sink or swim? And they're asking questions like, does this company have a real competitive advantage? What's their growth potential? Are there any external factors like new regulations or, disruptive technologies that could impact their business?
So they're really trying to predict the future here.
In a way, yeah. And this part is really interesting because it's not all about numbers. They're talking to customers, they're analyzing industry trends, they're even looking at the target company's marketing and sales strategies.
Okay, so it's a more holistic view. They're looking at the big picture.
Exactly. Taking the pulse of the market, if you will.
I like it. What other aspects of due diligence are there? This is like way more in-depth than I thought.
Oh, yeah, we're not even close to being done. One area that's becoming more and more important these days is cultural due diligence.
Cultural due diligence. Okay. What is that?
It's all about figuring out if the two companies' cultures are compatible. Are they a good fit? So they're looking at things like management styles, employee values, communication practices, all that good stuff.
So you're not just merging balance sheets.
Yeah.
You're merging, like, people.
Exactly. Because remember, a successful merger or acquisition, it's not just about the financials.
Right.
It's about people. It's about making those two companies work together, which can be tough if their cultures are total opposites.
Yeah, you don't want, like, a clash of civilizations within the company.
Exactly. You don't want a corporate culture war.
Right.
So yeah, cultural due diligence is all about trying to anticipate those challenges, those potential points of friction that might pop up during the integration process.
So it's like you're playing corporate matchmaker.
In a way, yeah. But it's serious business, right? You're looking for red flags, anything that might make it hard to bring these two companies together. Things like, conflicting values, communication breakdowns, resistance to change.
Yeah. Okay, so cultural due diligence. Make sure that the people are going to jive.
Exactly. The human factor is huge.
Okay.
All right, now let's talk about the lawyers. We've got to talk about legal due diligence.
Okay, everyone's favorite.
Right. This is where the lawyers really earn their keep. We're talking about a deep dive into all the legal documents, any legal issues that could impact the acquisition.
Okay.
So they're combing through contracts, looking at litigation history, intellectual property rights, environmental compliance, the whole 9 yards.
So it's like a full legal checkup.
Exactly. They're basically looking for any hidden risks, any legal liabilities that could come back and haunt the acquiring company later.
Yeah, I bet things like intellectual property are super important these days.
Oh, absolutely. Especially in this day and age. They're looking at patents, trademarks, copyrights, trade secrets, the whole deal. Making sure the company actually owns the rights to its technology, its designs, its creative assets. And of course, they're checking out the litigation history.
Right.
Seeing if there are any lawsuits, any patterns of legal trouble, any red flags there.
Okay, so again, just making sure there are no skeletons hiding in the closet.
Exactly. And this is why you need a good lawyer, someone who knows what they're doing. Because they know exactly where to look, what questions to ask, and how to assess the potential impact of any legal issues that pop up. You can't just use your friend who's a lawyer. You need someone who specializes in this.
Yeah, someone who does M&A in their sleep.
Precisely. It's a lot of work, but it's way better to be safe than sorry.
Yeah.
I mean, once the deal is done, there's no going back.
Right, no pressure. Right.
Yeah, exactly. But in all seriousness, due diligence is essential. It's an investment in itself, and it can save you a lot of headaches down the road.
Okay, so we've explored this due diligence thing. It's pretty intense. But let's say the detectives have done their job. Everything checks out. How do you actually determine what a company is worth? I mean, it's not like there's like a sticker on the building.
Right, right. That's the million-dollar question, isn't it?
Yeah.
And unfortunately, there's no easy answer.
Right.
Figuring out the value of a company, especially during an M&A, it's complex and it can be pretty subjective. But, there are established methods, frameworks that financial analysts use to get to a valuation.
So how does it work?
Let's break down some of the most common approaches.
Okay.
Okay, so one method is called the cost approach.
Okay.
And this basically focuses on the company's net asset value. It's a pretty straightforward accounting approach where you're basically taking inventory of everything the company owns,
Okay.
all its assets, right? And then you subtract its liabilities. And what you're left with is the net asset value.
Okay. So it's kind of like taking stock of what they've got and what they owe.
Exactly. However, this approach has limitations, especially with companies that have a lot of intangible assets.
Like what?
Things like brand value, intellectual property,
Yeah.
Things that aren't always easy to put a price tag on.
Right. Like you can't just like put a price on a company's reputation or how loyal their customers are.
Exactly. That stuff's valuable, but it's hard to measure.
Okay. So what else is there? What other methods do they use?
Well, another common one is the market approach.
Yeah.
And as the name suggests, this one looks at the value of similar companies that have recently been acquired or companies that are publicly traded.
So you're basically comparing apples to apples, right?
Exactly.
Like if company A, which is similar in size and industry to company B, was just acquired for a certain amount, that gives you a starting point for valuing company B.
Precisely.
Okay.
So within the market approach, you have a couple of methods.
Okay.
One is called the precedent transaction method, and the other is the comparable company method.
Okay, what's the difference?
So the precedent transaction method, it analyzes past M&A deals involving similar companies. And they use that information to determine a valuation multiple, like price to earnings ratio or price to sales ratio.
Okay.
And then they apply that multiple to the company they're trying to value.
So you're basically looking at what other buyers have been willing to pay for similar assets in the past.
Precisely. It's kind of like, when you're buying a house, the real estate agent will often pull comps
Right.
to see what similar homes in the area have sold for.
Yeah.
It's the same idea, just with businesses.
Okay. And what was the other method? Comparable company method.
Right. So the comparable company method, this one compares the target company to other companies that are publicly traded.
Okay.
Again, the goal is to find companies that are as similar as possible.
Okay.
And then they use market multiples to determine a valuation. The tricky part with this method is that it can be really hard to find truly comparable companies. And of course, market conditions can change. The market can be volatile.
Right. That makes sense.
Which can throw things off.
Okay. So what happens if you're trying to value a company that's like totally unique, like they're doing something that no one else is doing?
That's a great question. And that's where the income approach comes in.
Okay.
This approach is all about the future.
Okay.
It focuses on the company's future earning potential to determine its value.
So instead of looking at the past, you're trying to predict the future.
Essentially, yes. And one popular method under this approach is the discounted cash flow analysis, or DCF.
Okay. I've heard of DCF. It sounds complicated.
It can be, but at its core, it's pretty simple. You're basically projecting the company's future cash flows, right? How much money they're going to make in the coming years. And then you discount those cash flows back to their present value using a discount rate that reflects the time value of money.
Time value of money.
Yeah, so basically the idea is that $1 today is worth more than $1 tomorrow because you could take that dollar today, invest it, and earn a return. So by discounting those future cash flows, you're figuring out what those future earnings are worth in today's dollars.
Okay. So it's like, what would you pay today for that stream of income in the future?
Exactly.
Gotcha. So it seems like each of these methods, the cost approach, market approach, income approach, they each have their own pros and cons. How do you decide which one to use?
Yeah, that's the million-dollar question. And the truth is there's no one-size-fits-all answer. The best approach often depends on the specifics of the deal, the company's industry, what the company actually does, and even just the dynamics between the buyer and the seller.
Okay, so there's no magic formula?
Not really, no. It's a mix of art and science, really.
Yeah.
You're looking at the numbers, of course, but you also have to use your judgment, weigh the pros and cons of each method, and often you'll use a combination of approaches to come up with a valuation range that you think is fair.
So there's a little bit of wiggle room.
There's always some wiggle room in negotiations.
Okay, so we've got the valuation sorted out. Now what? How do these deals actually get structured and financed?
Yeah, That's a whole other can of worms. And that's where things get really interesting. The way these M&A deals are structured and financed, it can be just as complex as figuring out what the company's actually worth.
I bet. I'm ready to open that can of worms.
Well, we'll definitely have to dive into that next time because it's a lot to unpack.
Okay, so before we crack open that can of worms about structuring and financing these deals, you said it gets interesting. What did you mean by that?
Well, I mean, it'd be nice if it were as simple as just agreeing on a price and then, writing a check.
Right.
But financing an acquisition, especially when you're talking about big numbers, it's way more complicated than that. It's like this whole puzzle you've got to put together with debt, equity, and sometimes, you got to get a little creative. It's where the financial wizards really come in.
Okay, so walk me through it. Let's start with the basics. How do companies actually pay for these deals?
Sure. So the simplest way is just a straight up cash transaction.
Okay.
The acquirer, they just dip into their cash reserves, pay the seller, and boom, deal done.
Easy peasy.
Well, in theory, it is the cleanest and usually the fastest way to get it done, but it's not always possible.
Right, because not every company has that much cash just lying around.
Exactly. Especially if they're already investing heavily in their own growth.
Yeah.
So that's where debt financing comes in.
Okay.
The acquirer, they borrow the money, they could get loans, issue bonds, different ways to do it.
So they're basically using debt as leverage.
Exactly. It's like taking out a mortgage to buy a house. You're using debt to buy an asset, hoping that asset will generate enough income to cover the debt payments.
Right, but that sounds risky. What happens if the acquisition doesn't go as planned?
It's definitely a risk. Anytime you take on a lot of debt, you're increasing your financial risk.
Right.
Because if the economy tanks or the acquisition doesn't work out, suddenly you've got this mountain of debt and maybe not enough income to cover it.
Yeah.
So yeah, it can be risky. That's why the lenders, the investors, they do their homework.
They're not just handing out blank checks.
No, they're looking at everything. The terms of the deal, the financials of both companies, even the overall market conditions. They want to make sure it's a smart investment.
So it's a two-way street. The acquirer needs to find the right financing, and the lenders need to be sure they're not walking into a disaster.
Exactly. It's all about finding those deals that make sense for everyone involved.
Okay, so we've talked about cash, we've talked about debt. What about using stock to finance a deal? I've heard of that.
Right. Stock transactions are becoming increasingly common, especially in the tech world. Basically, instead of paying cash, the acquirer, they offer their own shares of stock as payment to the target company's shareholders.
Interesting. So instead of cold hard cash, the target company is getting a piece of the acquiring company.
Precisely. And there are some advantages to this. For the acquirer, it can be a way to hold on to their cash, which is always nice.
Makes sense.
It can also be a way to incentivize the target company's shareholders,
Yeah.
right? Because now they're invested in the combined company. Their success is tied to the success of the acquisition.
Right, so everyone's got skin in the game.
Exactly. But of course, it's not always that simple. Sometimes you'll see deals that involve a combination of cash, debt, and stock. Those deals can get really complex. You need some serious financial modeling and some pretty intense negotiations to find the right mix that works for everyone.
Right, because everyone wants their piece of the pie.
Exactly. And you want to make sure the pie is big enough for everyone.
So that's the financing side of things. What about the actual legal stuff? What role do lawyers play in all of this?
Oh, lawyers are essential in M&A.
Yeah.
I mean, they're involved in the entire process, from the due diligence we talked about all the way to negotiating the terms of the deal and then getting those final documents signed.
So they're not just like reviewing contracts on the sideline.
No, they're right there in the thick of it. They're like architects, really, making sure the whole deal is structured in a way that is legally sound, minimizes risk for their clients, and protects everyone's interests.
Okay, so they're drafting the blueprints for these deals. What are some of the key things that they're focused on when they're doing that?
One of the big ones is defining what type of transaction it's going to be. Is it a stock purchase?
Okay.
Which means the acquirer is buying the shares of the target company directly from the shareholders. Or is it an asset purchase?
What's the difference?
With an asset purchase, the acquirer is buying specific assets and maybe some liabilities directly from the target company,
Okay.
but not the whole company necessarily. The structure they choose has huge implications, both legally and for tax purposes, so it's a big decision.
Gotcha. So the lawyers are figuring out all the legal and tax stuff, making sure everything is by the book.
Exactly. And they're also spending a lot of time on these things called representations and warranties.
Representations and warranties, those sound like lawyer words.
They kind of are, but they're important. Basically, these are statements of fact about the target company that the seller makes to the buyer.
Okay.
And they cover everything. I mean, from whether the financial statements are accurate, to who owns the intellectual property, to any potential environmental liabilities.
So it's kind of like a guarantee from the seller that everything is as they say it is?
Exactly. The seller is saying, hey, this is what we've got, and we're putting it all out there. And these statements, these representations and warranties, they're usually backed up by indemnities, which are basically clauses in the contract that protect the buyer if any of those statements turn out to be false.
So like an insurance policy for the buyer.
Exactly.
Yep.
It gives them some recourse if things go south after the deal is done. And then, of course, there are regulatory approvals to consider. Depending on the size of the deal, the industries involved, there might be a whole bunch of regulatory hurdles to clear.
Like what?
Well, for example, they might need approval from antitrust regulators. The government wants to make sure that the deal isn't going to stifle competition or harm consumers.
Makes sense. You don't want to create a monopoly.
Right, so the regulators might require the companies to divest certain assets or take other actions to address those competition concerns. And this regulatory review process can take a long time, add a lot of complexity. Sometimes it can even kill the deal entirely.
Wow, so there are a lot of boxes to check before that deal is finalized.
Oh, absolutely. It's a long and winding road
Aw.
with a lot of twists and turns. But when it's done right, when you've got the right team in place, M&A can be incredibly powerful.
So we've covered due diligence, valuation, structuring, financing, even the legal and regulatory stuff. It's a lot. But what happens after the deal is done? Like after the ink is dry, the champagne's been popped, everyone's celebrating. Then what?
That's when the real work begins. We call it post-merger integration. And it's often the most challenging and honestly the most critical part of the entire process.
Okay, so tell me more about this post-merger integration. What's so challenging about it? So we left off talking about post-merger integration and how that's when the real work begins. You said it can be really challenging.
Oh, it definitely can be. It's where the rubber meets the road, right?
Yeah.
All those grand plans and synergies, they either come together or they completely fall apart.
So what are some of the biggest challenges companies spend all this time and money on a deal? And then what trips them up during integration?
Well, one of the most common challenges, and we've touched on this a bit already, is cultural mismatch.
Right, because even if you do your due diligence, even if you try to assess the cultures beforehand.
Exactly. You can't always predict how those cultures are going to interact once you're actually trying to merge two companies with different ways of doing things.
So it's like those cultural differences, they might seem small at first, but they can become major roadblocks once you're in the thick of it.
Precisely. Things like communication styles, how decisions are made, even just different approaches to work-life balance. Those things can create a lot of friction.
And friction can lead to misunderstandings, conflicts, and ultimately impact morale and productivity.
Exactly. It's like trying to mix oil and water.
Yeah.
Sometimes those cultures just don't want to blend.
So how do you overcome that? What can companies do to try to bridge those cultural divides?
Communication is key. I mean, clear and consistent communication from the leadership team. Employees need to understand what's happening, why the merger or acquisition happened, what the vision is for the combined company, and how their jobs might be affected.
It's about managing expectations, addressing concerns, being transparent about what's changing and why.
Exactly. You've got to keep people informed. And you've got to be sensitive to the fact that change can be unsettling for people.
For sure, it's a time of uncertainty, and people want to know what the future holds.
Absolutely. And speaking of leadership, that's another big challenge, leadership alignment. When you bring two companies together, you often have two sets of leaders with different styles, different experiences, maybe even competing visions for the future.
Right, so it's like having two captains trying to steer the same ship.
Exactly. And if those leadership teams can't find a way to work together, to establish clear roles and responsibilities, and to present a united front to the rest of the organization.
It creates confusion and undermines the whole integration process.
Precisely.
Yeah.
It's crucial for those leadership teams to build trust,
Yeah.
to be able to have open and honest communication, and to make decisions together.
And then, of course, there's the whole operational side of things. Merging IT systems, business processes, physical locations. That can't be easy.
Oh, it's a massive undertaking. It's like trying to solve a giant jigsaw puzzle
Well,
while the clock is ticking, and you're trying not to disrupt the day-to-day operations of the business.
so you need a really detailed plan, clear timelines, responsibilities, and a way to keep everyone informed about what's happening and when.
Exactly. And you need people who have done this before, integration specialists who can help guide the process.
Yeah.
and anticipate potential problems.
So we've talked about the challenges, the cultural clashes, the leadership issues, the operational headaches. Are there any other common mistakes that companies make during this post-merger integration phase?
Oh, sure. One of the biggest mistakes is underestimating the time and resources required for a successful integration. Companies get so focused on getting the deal done that they don't always think through what happens after the ink is dry.
It's easy to underestimate the complexity, the amount of change management involved. It's not just about merging spreadsheets and org charts.
Exactly. You're merging people, processes, cultures. It takes time, and it takes dedicated resources.
And communication. We talked about that earlier, but it's worth repeating.
Absolutely.
Yeah.
Companies sometimes make the mistake of not communicating enough or not communicating clearly with their employees during the integration process. And that can be really damaging.
Because when people don't know what's going on, they start to fill in the blanks themselves. And that's when rumors start to fly.
Exactly. It's crucial to be transparent, to keep those lines of communication open, and to address concerns head on.
And I imagine customer experience is another area where companies sometimes drop the ball during a merger or acquisition.
Oh, absolutely.
Yeah.
They get so caught up in the internal stuff that they forget about their customers.
Yeah.
And that can be a recipe for disaster.
Because at the end of the day, it's those customers who are going to determine the success or failure of the merger.
Exactly. You've got to maintain that customer focus throughout the entire process. Make sure their needs are being met, that their experience isn't being negatively impacted.
This has been incredibly insightful. I feel like
Excellent.
we've pulled back the curtain on a world that most people only hear about in headlines.
It's definitely a complex world,
Mhm.
but it's also a fascinating one.
We've talked about the motivations behind these deals, the due diligence process, the different ways to value a company, the complexities of structuring and financing those transactions, the challenges of post-merger integration, the roles of private equity and venture capital, and we've even debunked some common misconceptions about the M&A world.
It's a lot to digest,
Yeah.
but hopefully our listeners have come away with a better understanding of how this world works.
So as we wrap up this deep dive into the world of mergers and acquisitions, what are some key takeaways our listeners should keep in mind?
Well, first and foremost, remember that M&A is a strategic tool. It's not an end in itself. Before even thinking about acquiring another company, ask yourself, what are your goals? What are you trying to achieve? And is M&A the right way to get there?
Don't just do a deal for the sake of doing a deal. Make sure it aligns with your overall strategy.
Exactly. Second, due diligence is absolutely critical. Don't cut corners. Don't rush it. You need to understand what you're getting into before you sign on the dotted line.
Knowledge is power, especially in the M&A world.
Absolutely.
Yeah.
And third, don't underestimate the importance of integration. The deal itself is just the beginning. The real work starts after the ink is dry. You need a solid plan, and you need to be prepared to adapt and adjust along the way.
Because no two integrations are exactly alike.
Precisely. And finally, remember that M&A is a dynamic and constantly evolving landscape. What worked last year might not work this year, so it's essential to stay informed.
Read the trades, talk to experts, keep your finger on the pulse of what's happening in the M&A world.
Exactly. Because the more you know,
Yeah.
the better equipped you'll be to navigate this complex and ever-changing world.
This deep dive has been quite a journey. We've explored the motivations of buyers and sellers, we've navigated the complexities of due diligence valuation and integration, and we've learned that M&A is far more than just a financial transaction. It's a strategic game, where the winners are those who can anticipate their opponent's moves, make bold but calculated decisions, and ultimately shape the future of their industries. Thank you for joining us on this deep dive into the world of M&A.